Good morning, Namaskar. Welcome to the program ज्ञान से कल्याण Basics of Accounting for class 11, 12, BCom, BBA, BCA, MCom, MBA, CA, CS, ICWA. My dear friend, this is the basic of all accounting purposes. Whether someone is doing accounting work in any company or in any organization. So today we are going to start new chapter, that is share capital. In this slide, few introduction about myself. Dr. Baidyanath Ram Prajapati is given. So meaning of company, what does it mean? Because we are going to do the accounting for share capital. So the share capital is the capital of the company. This is collected from the members of the company. So here what the company means. First we have to understand about the meaning and definition of company. We all know that there are basically three forms of business organization, or a business can be organized either under sole proprietorship, where there is a single person who is starting, controlling, managing the business, and he is solely responsible for all the profit and losses. And the second very important form of organization is partnership business. There are certain limitations of the sole proprietorship. When business grows, when business become big, so that cannot be managed by a single person. There are some shortage or some limitations of the decision making and these resources, that is the capital. So the another form is, that is partnership form, that is when two or more persons are joining hand. They are contributing capital, technical knowledge, and the expertise, and they are doing the business. And the third very important form of organization is company form of organization. So this is the big form of organization, and all over the world, big business are managed and controlled under this company form of organizations. So all the affairs of the company are governed by the provision of the Companies Act 2013. So here a small definition is given. A company means a company incorporated or registered under the Company Act 2013 or under any other earlier Companies Act. So this is a very simple definition. So now we are coming the definition given by Chief Justice Marshall. Very important. This definition carries all the features of a company. Important features, characteristics are highlighted by this definition. So here, a company is a person, artificial, invisible, intangible, and existing only in the eyes of law. Being a mere creation of law, it possesses only those properties which the charter of its creation confers upon it, either expressly or as incidental to its very existence. So here charter means the documents which are very important for creation of a company. There are two important documents, that is memorandum of association and articles of association. So as I explained, that definition which is given by Chief Justice Marshall carries all the features. So now we are going to discuss the features and characteristics of a company. So here the first one is body corporate. The second very important feature is separate legal entity. It can hold and deal with any type of property. It can enter into contracts and even open a bank account on its own name. The next one is limited liability. This is the special features of a company. The liability of the members of the company is limited to the extent of unpaid amount of the shares held by them. Next, perpetual succession. Member may come and may go, but the company continue forever. So my dear friend, like a river, water may come and water may go, river will forever. The next one is common seal, and the next feature is transferability of share. One can transfer his share n number of times and may sue or may be sued. Company may sue on any other person, or it may be sued by any other person. So next one is different types of the company and kinds of companies. On the basis of liability of its member, the company may be limited by shares, or companies limited by guarantee, or it may be a unlimited company. So on the basis of number of members, company can be divided again into three categories. The first one is public company, in which public at large is involved. A company which is not a private company and company which is not a subsidiary of a private company. This definition and type is given under the Act. Next, private company. A private company is one which by its articles restrict the right to transfer its shares. Second one is a private company must have at least 2 persons, except in case of one person company. We will discuss in coming slide what is one person company. And the third type is limits the number of its member up to 200, excluding its employee. So here one person company, OPC, section 2 subsection 62 of the Companies Act 2013 defines OPC as a company which has only one person as a member. Rule 3 of the Companies Act Incorporation Rule 2014 provides that only a natural person, being an individual citizen and resident in India, can form one person company. A company it cannot carry out non-banking financial investment activity. The third feature, it paid up share capital is not more than rupees 50 lakhs. The next very important feature is it average. Annual turnover of 3 years does not exceed rupees 2 crores. So these are the feature and important characteristics of one person company. So now we are coming to the practical part. We will see how the accounting entries are made in the books of account for issue of shares. So here reissue of share, when issue of share at discount, is forfeiture of shares, reissue of shares. So these all we are going to discuss. Categories of share capital. So there are different parts of the share capital. The first one is the authorized share capital. Authorized share capital is the amount of share capital which a company is authorized to issue by its memorandum of association. Issued capital. Next one is subscribed capital, called up capital, paid up capital. So these all are the different forms and types of share capital. And the another one is uncalled capital. This is also, and the next one is reserve capital. A company may reserve a portion of its uncalled capital to be called only in the event of winding up of a company. Shares, what does it mean? Fractional part of the capital and forms the basis of ownership in a company is called share. Shares are generally of two types. The first one is equity share capital and second one is preference share. So how the share is issued? Share of company is collected by issuing shares to either a select group of persons through the routes of private placement and offered to the public for subscription. Shares are issued either for cash or for consideration other than cash. The former is being more common, or a cash issue is very frequent. So shares are said to be issued for consideration other than cash when company purchases business or some assets. The vendor have agreed to receive payment in the form of fully paid shares of a company. So what are the stages of receiving money? So stages of share issue. First one is company may receive money on application for shares, then allotment of shares, calls on shares. So share may be issued at par, at premium or at discount. Calls in area is also called unpaid calls. So when share is issued, it may be over subscription or it may be under subscription. So over subscription means more than share received than number of share offered for subscription. Issue of share at premium, when the price of share is more than par value or nominal value, it is called share issued at premium. And when the share issued is premium, the amount is credited in a separate account that is called securities premium or reserve account. So share capital of a company, the amount contributed by the shareholder is called share capital. So very important. 1 marks question, objective type question may be asked, what is share capital? So innumerable stream of capital contribution by the shareholder merge their identity in a common capital account that is called share capital account. Here, very small questions for better understanding is given. So, what is public company? What is private company? When share can be forfeited? What is meant by calls in arrear? So now we are proceeding to the next part, that is nature and classes of share. Preference share, equity share, issue of share. Just we have discussed the important step in the procedure of share issue are here. Issue of prospectus, it is very important. Without issuing the prospectus, no company can call the share. So it may be receipt on application. So here brief description is given, allotment of share. So now we are proceeding to the practical part, that is accounting treatment. So what is the main journal entry we can make? So here brief introduction about the treatment of issue of share is given on application. General entry is bank account debit to share application account, and brief narration should also be provided. For transfer of application money, share application debit to share capital. For money received on, for money refunded on rejected application when there is oversubscription and company is returning the money. So here the journal entry will be share application account debit to bank account. For allotment amount due, share allotment account debit to share capital account. So here for adjustment of excess application money may be made on the allotment stage or on the calls in advance. So here for the allotment adjustment of excess application money with the allotment, share application account debit to share allotment account. For receipt of allotment money, bank account debit to share allotment account. So here one combined entry can be made for return of money and transfer of application money to allotment account, share application debit to share allotment to bank account. A combined account for share application and allotment can be made on receipt of application and allotment, bank account debit to share application and allotment account. For transfer of application money, share application allotment debit to share capital. On calls, journal entry will be share calls account debit. It may be first call, second call, third call and final call. So here a common entry is given, share calls account debit to share capital on receipt of calls money, bank account debit to calls account. So here one practical question is given for better understanding. So here suggested answer is provided. So you try yourself and you can compare with the given answer. More practice will make you perfect. So try to do more practice. So book of over limited, here journal entry is continuing. So corporate form of organization. So just we have discussed a corporation is a legal entity created by law that is separate and distinct from its own. So classification of corporation, as we have discussed, corporation purpose may be earn profit or may be for non-profit. It may be public limited or private limited. So here again the features are provided for better understanding. Separate legal existence, limited liability of shares, transferable ownership right, ability to acquire capital, continuous life, corporation transaction management, government regulation, and additional taxes. So here some advantages and disadvantages are given. What are the advantages? Corporate management, professional manager, separate legal existence, limited liability of shares, deferred or reduced income taxes, transferable ownership, and ability to acquire capital, continuous life. Here some of the disadvantages are corporation management ownership separate from management, increase cost, complexity to adhere the government regulation. In case of company form of organization, a lot of legal provisions are there which has to be complied every year. Company has to be get it audited. It must be file its return every year to the registrar of company. So potential for additional income tax. So again there are organization cost. So for forming the company or organization, whatever cost is incurred, that is called organization cost. The cost include fees to underwriters, legal fees, incorporation fee, and for promotional expenditure. So cost is also involved there. So again, every so corporate capital, as we have discussed, shareholders equity, owners equity, contributed capital, that is share capital, additional contributed capital, and return earning. So these all parts included call the corporate capital and the company capital. So share capital plus reserve and surplus forms the company capital. So next one is the preference share or preferred share. So there are two types of the priority, that is the dividends and assets. In case of liquidation, that must be first paid to the preference shareholders. But the preference shareholder usually do not have the voting rights. So the preferred shares are shown first in the share capital section of the shareholders equity. So again, here some features are given: liquidation preferences, cumulative dividend in arrears, convertible, it may be converted into debentures or shares, redeemable, callable, return on equity. So return on equity or return on investment is considered to be most important measure of firm's profitability, and this is also known as ROE. It may how many dollars or how many rupees are earned each dollar invested by owners. So here net income divided by average shareholder gives us return on equity. As we told you, this is the basic measure of the profitability. Book value per share. Book value per share represent the equity a common shareholder has in the net assets of the company from owning one share. So here one formula is given: total shareholder equity divided by number of common share or number of share gives us book value per share. Or so example of extraordinary expenditure or items. Here this is very important. In case of the company form of organization, there are some expenditure which is in the nature of extraordinary. So some here the comparison between extraordinary and ordinary items are given. Effect of major casualty like acts of God if rare in the area, exploration, takeover of property by the government, effect of a newly enacted law or regulation such as Condemnation Act. So these all are the extraordinary items. So effect of major casualty good if frequent in the area, write down of inventory or write off receivables, loss attributable to labor dispute, gains and losses of sale of fixed assets. So these all are the normal items. This is very important. Next one is price earning ratio. So my dear friend, this is very important. This is called PE ratio. It helps the investor to determine whether the shares are good investment in relation to earning or not. It is a per share calculation calculated by dividing the market price of share by its earning per share. So here equation is given, market price per share divided by earning per share. It gives price earning ratio. A high PE ratio can be one indicator that investors believe the company has future growth potential. Prior period adjustment. This is very important. There are some prior period item as well. A correction of an error occurs after the books are closed and related to a prior accounting period. Next one is the dividend. What does it mean? A dividend is distribution by a corporation, its shareholder, on a pro rata or equal basis. Dividend may be in form of cash or in form of shares. Extraordinary item. Here some examples are given. Extraordinary item are event and transactions that meet the three conditions. Infrequent, non-typical, not subject to management decision. Extraordinary items are reported net of income tax in separate section of the income statement immediately following discontinued operation. Earning per share, EPS. As we have already seen, company reports earning per share on income statement. The formula to calculate earning per share when there has been no change in the share during the year is given as under. Net income minus preference dividend divided by number of share gives us EPS. So here, my dear friend, a small description about the Vishwa Manav Kalyan Charitable Trust, on behalf of which we are providing the various services, are given here. Thank you very much.